Okay guys, I'm going to pick up where I left off, which is 2.8 of journal entries and adjustments. 2.8 says equipment of 2,000 Rand cost price was purchased on the 1st of July. So we are at the end of December, so that's middle of the year. Now, I was a little bit confused about whether or not that equipment has been accounted for. But it seems like the only thing they want us to do is work out the depreciation, because 2.9 says depreciation must be provided as follows. So it's not the adjustment that you have to do. You can assume that the equipment is in there. They just want you to work out the depreciation, which brings us to depreciation. So equipment of 2,000 Rand was purchased on the 1st of July. Now if we go to equipment over here on this side, equipment at the end of the year is on, so end of year is at 9,000. Okay. But 2,000 of that we only purchased in the middle of the year. So middle of the year is 6 months. And the remaining 7,000 we had from the beginning of the year, 12 months. Now they want us to work out depreciation on a diminishing method. What is it? Diminishing balance method. So there's straight line and diminishing. Straight line says if it's at 10%, then this one would have been 700. Straightforward. But diminishing value means I have to take the accumulated depreciation away. So we bought this equipment for 7,000. Then we have to minus the depreciation that's been accumulated over the years, which is 1,710. And that new value. So if we take the 7,000, why 7? It was 9. That 2,000 is we bought new this year, so we just remove it. We're going to do it just now. Take the 7,000 minus 1,710 equals 5,290 and 10%. Then, okay, so this is now your value. So this is your brand new car that you bought's price minus the depreciation at that 10% that they give you. So that one that says that the depreciation will be 529. Take that 10 out, put it here. Maybe I went too quickly. Okay, let me just do this again because I don't think I've ever done this on a video, so it might be your first time seeing me do it. Okay, the question states that equipment of 2,000 Rand was purchased in the middle of the year. Our trial balance gives us equipment from the beginning of the year. Now at the beginning of the year, no, that's vehicles, equipment. At the beginning of the year, the value for our equipment was 9,000. Not the beginning, the end, sorry, 31 December. There. End of the year it was 9,000. This is end of the year. At the beginning of the year, it should have been worth 7,000 because they tell us equipment of 2,000 was bought 1st of July. So that's why we can see it's worth 7 now, and there's our 2,000 new one. Now we have to work our depreciation on that 7,000. But they want the diminishing value, so we need to take away the accumulated depreciation of 1,710. That gives us the 5,290. Ooh, that's a horrible 5,290. This is now our value. Then we take our value and we times it by 10% because they said in the question, equipment is at 10% per annum on the diminishing balance method, and that gives us 529. So we write here for equipment 529. But we haven't worked out that little one over there. You see, the new one. So we have to work out the new one as well. But the new one is just for 12 months. And the new one has no accumulated depreciation because it's new. So how can anything have accumulated? So the new one, we take the 2,000 Rand times the depreciation, which is 10%, or 10 divided by 100. But that'll give us depreciation for 12 months, and we only want for 6 months. So we say, okay, fine, times 6 divided by 12. And that, I think it comes to 200. Let me just check again. So we put in 2,000 times 10 divided by 100. So it's 200 for the full year. 6 divided by 100. 6 divided by 12 gives us 100, sorry guys. So that's 100. And then the total depreciation for the year is 629. Luckily I know this is right because I've got a memo. Okay, that is our depreciation on equipment. Now depreciation on vehicles. So vehicle value at the beginning of the year. Vehicles at cost, 40,000. Vehicles 20% per annum on diminishing balance. So diminishing balance means take the accumulated away. So we have a look for the accumulated depreciation on vehicles, which is 11.2. We take that away to get a value. What's that, 29, 28? You gotta be kidding me, it doesn't want to work now. Ah, okay, fine. That would be 30 minus 1,000, 40, 30, 29, 28,800. Plus minus, I'm not sure. Times 20%. And I'm going to just check the memo for this one because my calculator bailed on me. And that value that you're supposed to get is 5760. Okay, 5760. Oh, there we go, it's working. That's very strange. 40,000 minus 200 equals 28,800 times 0.2 equals 5760. Great. That is our depreciation on vehicles. Now, what is this depreciation thing that I'm speaking of? There's a video on it. It's a very fluffy video just to explain the concept behind it. Now I just want to do the journal entry. So my journal entry is going to say depreciation is an expense. We haven't accounted for it yet. We still have to. Their expenses gets debited and the expense's name is depreciation. Depreciation. Then we take the total, which is this amount plus this amount. Depreciation total amount 6389. And now something we haven't done yet is we're going to have two credits. We're going to say accumulated depreciation on vehicles. That's my car. And accumulated depreciation on equipment. This one is debited. This must both be credited. 5760 and 629. Great. There we go. So we have our depreciation, which is our expense, and we have the two accumulated depreciations for those two. Later on, I don't think I'm going to get to it today, but when you do that note on property, vehicles and equipment, you'll use this information because you'll have to add this accumulated depreciation to the accumulated depreciation they gave you to get to the new value of the vehicles and equipment. Okay, next up. The account of loose ends limited, a debtor who owes the entity 200 Rand, must be written off as irrecoverable. So the account of loose ends limited, so the guy's name is Loose Ends Limited, and he's a debtor. So if they say debtor, in the old days, they used to make the account name debtors as well, but now it's changed and I need to remember the new one the whole time. It's very tricky, but it is trade receivables control. So here, trade receivables control, we have to write off his 200 Rand. So at the moment we're sitting with a asset, a debit asset of 200, but he's never going to pay us. So we have to take it out of our book. So it's credit. So on the credit side, we've got, the guy's name is Loose Ends. And that goes into our trade receivables control, except it's going out because we're making it less, 200. Then on this side, it must be written off, so we write credit losses. Losses. 200. If I remember correctly, this is a income and expense account, and it's an expense, so if we debit it, equity goes down. Great. And we write here, account written off as irrecoverable. Then the very last one of the adjustments we need to do. Looks very easy, but it's not. They say 12.11. It was determined that on 31 December, the allowances for credit losses should amount to 250. Allowances for credit losses. Now, that's a whole new account. The one we just used, that was credit losses. Now, they're talking about allowance for credit losses. Completely different thing. If I remember correctly, it's a liability. And it sits here somewhere. Allowances for credit losses. Here on our trial balance, allowances for credit losses, 300. So what they're saying is we have a liability over here of 300. But they want to make it 250. So we have 300. They want the value to be 250, so we write it off by putting the 50 on that side. So we're going to debit allowances. Allowances for credit losses, 50. Okay, that's the debit account. And then the credit account is that other account that we just used to write stuff off, credit losses. Now this is very bizarre because if you now look at it, we wrote off money on that side, now we're putting in money over there. But it does make sense in a way, because when a liability goes down, your equity in a way must go up. So it makes sense, even though it's very bizarre. If you're going for like a distinction or something, try and figure out this one, or memorize it, but otherwise don't bother too much. Although it's not that hard, is it? It's not really that hard. You just remember, allowance for credit losses is a liability, where credit losses itself sits here under income and expense and equity. Oh, and then we have to write something. We just write here adjustment of allowances for credit losses. So we're just adjusting it. Adjustment of. And that brings us to the very end of the adjustments they wanted us to do. Quite a lot of information in this one. I hope it makes sense. We've done all the difficult work now. B says prepare the closing journal entries. Post these journal entries to the trading and the profit and loss accounts. Now, you've done the difficult work. You really have. It's all done. I know it only counts 12 marks, but it's the difficult part. The 34 marks, now that you've done the hard part, is going to be so much easier. What you just need to know is what they mean with the trading account and the profit and loss account. Now, because I'm running out of time, I am going to cheat and refer to the memos. Just because I really want to show it to you. So this one is a lot of marks right here, where the profit and loss, how do I explain this? So all your expenses that you had, for example, on your trial balance, there's all the expenses, advertising that we worked on, and we worked on packaging and all of those things. In this account, we put it on this side the whole time to say it's an expense that's going to bring equity down. Now the closing is the part where it actually brings equity down. So if we look at a general ledger account here of packaging material, it was an expense, so it's on this side. The packaging expense we had was 4,700. This amount comes off the trial balance. Then we we moved some of it into inventory. And we are left with 3720. This 3720 amount, we now want to square. So we're going to take this to profit and loss. So on this side, we are now going to write profit and loss. Am I doing this correctly? Goes there, goes there. Wow. Because we're running out of time, I have to make this very short. If you're around next semester, which I really hope you're not, you can just ask me to do another video on this. But have a look. The profit and loss gets debited. Profit or loss account. Okay, profit or loss. And then that's the total amount, and you just write all your expenses of the trial balance over here with the changes that you've made to it. So your credit, your packaging, for example, had a change, your insurance had a change, your telephone had a change. So all those things we've done just now, you write the new amounts and then you credit that. So that's also a lot of like easy marks. And I think I'm going to leave it there for now. Okay. Good luck. I wish I started earlier in the term to help you. It was just a mad rush and I ended up only having time now. But go through the videos and have a look at all